Welcome to the next installment in my video lecture series for international economics. And in this particular video lecture, I'm going to be taking a look at national income accounts. In particular, we're going to be taking a look at the differences between GNP versus GDP. First, realize what gross national product is. And you can see by the slide, we have the book definition, but I've highlighted a portion of the book definition just to elaborate a little bit more. You can see that value there is highlighted and sold on the market. So the goods and services that are used to calculate GDP, the value is based upon the market price, what is produced in the market. So for example, if I go out to my local pizza shop and buy a pizza for $14 or whatever it happens to be, the price I pay, the market price, is the value that's associated with that particular product. Also, you can see there that final goods and services is highlighted. This is very important. None of the intermediary goods that a producer uses to make a particular product, those intermediary transactions are not included because of the fact that for example, if I buy a pizza, the costs that the pizza shop owner has buying wheat, cheese, tomato sauce, etc. Those transactions aren't included because those costs are already included in the final price. So realize that it's the final goods and services, that the intermediary transactions that occur prior to that final sale are not included because they are included, those costs are included in that final price. Also, you can see that I have the country's factors of production highlighted. That means that regardless of where that particular factor of production is located, as long as it's owned by an individual of that particular country, it counts towards that country's GNP. As an example, let's say I owned a factory in Belgium. All right, it would count towards that factory's output, and the income associated with that will be in the United States and not in Belgium, because of the fact that it's a factor of production owned by a United States citizen, regardless of where it is located in the world. GDP is a little different, and we'll go over GDP, and it depends upon the location of the factor of production, not the ownership. And finally, you can see there at the bottom we have a time period. So we have GNP for 2015, 2014. So it measures the value of those final goods and services produced by a particular country's factor of production, and it is valued at that market price during a particular time period. All right. Realize that the GNP is broken down into 4 separate categories. We have consumption, and think of consumption as consumption by private residents going out and buying a pizza, soda, etc. That definition of consumption. So it's by private citizens, so it's not government purchases. Investment, this is by private firms. So if they buy new plant, new equipment, new computer systems, new software, etc., that is considered an investment because it's used in present and future production. So it's considered an investment. We also have government service purchases, so it can be government services. Anything that the government purchases falls under that category. And also the current account balance, which is net exports. It's exports minus imports. So realize that we have this kind of classification so we can classify transactions that contribute to the national income by the different type of expenditure. So if it's consumption, investment, government, or current account, and how those transactions contribute to national income. Realize that there are why this equality holds. Make sure you have an understanding of why this equality holds, and your book does a good job of giving you an example. But let me show you this from my own personal example. I recently had a leak at my house, and I had to hire a plumber, and the plumber charged me $200 in order to fix the leak. So realize that that $200 worth of services that I received counts towards GNP, but it also is income because the $200 of services equated to a $200 payment to the plumber to provide those services. So you can see from that transaction, that or sort of oversimplifies things, but just realize why this equality exists of production and income are the same. And realize you can do the same thing with goods, but also realize that that issue of double counting, by definition, we said that it's final goods and services. So, for example, the pizza place selling me a pizza, we would not count the transactions of that individual buying wheat, buying flour, buying tomato sauce, buying cheese, buying yeast, all those different things wouldn't be counted towards national product because they are counted as the final product and included in the cost of that final product that was sold by the individual who owned that pizzeria. Now realize that this equivalence is not exact and that some adjustments have to be made to GNP in order to get this equivalence to be an equivalence is one way of saying it. All right. So realize that we calculate net national product, which is just GNP less depreciation. And depreciation is the economic loss that occurs if your factory, your machinery, those things have a tendency to break down and wear out. So you might have 15 pieces of equipment to produce things. At the end of the year, if you don't do maintenance on them, you only have 14 left. That would be depreciation, a capital depreciation. So make sure you realize that in order for the equivalence to hold, we have to take into account depreciation. Also realize we have to take into account unilateral transfers. And by that I mean, and just a couple of examples, that, for example, if I were ever to retire from Rutgers and move abroad, any pension payments I would receive as a unilateral transfer, that would have to be taken into account because technically it's income, but it's not production that's occurring. I'm not doing anything for that pension. I'm just sitting there staying alive in order to get that pension. So you have to realize that if somebody's receiving a pension payment and they've moved out of the country, that's a payment of income to an individual, but there's no production associated with that. And also if you have foreign aid, for example, if you have donations that are for relief funds, there's a disaster, a tsunami, an earthquake, those unilateral transfers also have to be adjusted out or in depending on your location. So realize that national income is equivalent to GDP, less depreciation, and then you have to add in any net unilateral transfers that actually occur. And then we have that equivalence that we talked about of income and production being equivalent to one another. Now with GDP, just make sure the only difference that you see here is the fact that now it's the same thing of saying the value of final goods and services, but it says produced within a country's borders. So it's still sold on the market and it's at the market price at the same time period, but the designation is within a country's borders. So for example, remember what I told you about me owning a company in Belgium. If I own a company in Belgium, that would count towards GNP in the United States. That would count towards GDP in Belgium because it's physically located within the borders of the country of Belgium. So make sure you understand that distinction between gross national product and gross domestic product. Also, let's make some identities. It would be a good idea for you to remember with this national income accounting. Remember that we said Y is equal to C plus I plus G in a closed economy. That's the identity because since it's a closed economy, there is no international trade going on, so we don't have to concern ourselves with exports and imports. Once the economy is opened up, we have to include exports and imports into this equation. So on an open economy, Y is equal to consumption plus investment plus government expenditure plus exports, but we have to subtract off the imports because those payments are flowing out of the country. We are purchasing items from another country, so it's not production that is accruing income in the United States. That payment is becoming income to an individual in another country. And just remember that when we talk about this, the current account balance is just that when we open up the economy, it's the exports minus imports. So remember that whenever you see current account, you know that it is exports minus imports. So, for example, United States, we have a current account deficit in the United States because we import more than we export. So the current account has a negative balance associated with that in the United States. In other countries, they have a surplus. They export more than they bring in imports. So they have a current account surplus. And finally, just make sure you realize the relationship with savings and the current account. In a closed economy, savings is equal to investment because there are no funds flowing across international borders. So in order to invest, there has to be somebody willing to save within that domestic economy. So the level of investment has to equal the level of domestic investment has to equal the level of domestic savings. All right. If you want to invest and there's no savings available, that investment can't occur. Once the economy occurs, then we allow for the international flow of goods and services and finance. So loans can be made across international borders. And under an open economy, savings is equal to investment plus whatever occurs in the current account.